Mr. Purohit, Mr. Purohit, are you there? You have to unmute and speak. Purohit, am I audible? Anil, am I audible? Mr. Anil?
Yes, sir.
Yeah, I'm audible.
बोलो ना.
Am I audible? I asked you.
Yes, sir. You're audible, sir.
Okay, okay. Welcome, welcome. Vikram,
Thank you, sir.
welcome.
Thank you.
Thank you, sir.
Good afternoon. Savri, am I audible?
Yes, sir, you are.
Okay. So it's 5:30. Let us start the evening. Savri is going to brief about the why this webinar and what are the advantages of attending the webinar. Thanks for joining on sharp at 5:30. Yes, over to Savri.
Thank you so much, sir. I hope I'm visible as well as audible. So, welcome everyone to this edition of the FX Periscope webinar. Thank you for joining us today. As many of you know, FX Periscope is our monthly report that delves deep into the technical and economic analysis of the Forex market. These reports are designed to offer businesses, investors, and market participants critical insights that help in making informed decisions, managing risk, and seizing opportunities in the ever evolving world of currency markets. So, today's session will focus on how to best utilize these reports, covering key trends in the USD INR pair and other major currencies. So, we'll be explaining how our analysis, both technical as well as fundamental, can provide the confidence needed to navigate market volatility, safeguard your positions, as well as capitalize on opportunities. Our goal today for this webinar is to educate you on how to interpret these insights from FX Periscope and effectively apply them in your strategies for managing Forex exposure. So, with us today are our esteemed speakers, Mr. Vivek Kumar and Mr. Yashwant Rao, who will be guiding you through the latest analysis and will be offering practical advice on using these reports to your fullest advantage. Over to Mr. Vivek Kumar. Vivek, sir?
Savri, give me a couple of minutes. I'm facing problem in joining.
Sure, no issues.
I will take this time to
Biju, sir, I think you're on mute if you were trying to say.
just till Vivek joins, let me give him a very brief introduction of Vivek. Vivek is an economist and he was working in ICICI Bank and S Bank over a decade. And his articles are most sought after and analysis on rupee especially. He focuses and he puts his heart and soul to get this report out. He has been heard and he has been speaking in our rupee money conference. Vivek, once you are ready, you can take over. You need some more time?
Sure. Savri, can you enable my other ID also for screen sharing? So you'll see two Vivek Kumars.
Vivek, you have to make
Yeah, can you please check whether it's happening now?
Yes, it's happening. Thank you.
Yes, Vivek, over to you.
So let me know if the screen is visible to everyone.
Yes.
Okay, great. So good evening and thanks Venkatesh and Savri for starting it on time. We have quite a bit of ground to cover. And this is a continuation of our FX Periscope webinar series that we kick-started last month in collaboration with it's a collaboration between QuantEco Research and First Basis that has now seen almost 12 months of association, nearly about 12 months. And the webinar is the second in the series. Now, for this particular month, the month of September, the topic that we chose is managing stretched overvaluation in case of INR. So last 1 month, so we have been highlighting this for some time through our FX Periscope reports that INR is looking overvalued slightly more than the usual norm. And the last 2 months, especially, we have been also highlighting that the overvaluation levels are getting stretched. So this time around, we decided to focus on what to do when you have a stretched overvaluation, or how would policymakers react? What would it mean for market participants? etc., etc. So we'll also be opening the session for Q&A later on with Venkatesh's kind permission. And then, without much ado, let's move forward.
Vivek, if possible,
Last,
can you put on your video?
this will save my bandwidth, Bijur. That's it.
No,
Anyways, the screen is visible.
Okay, fine.
So I'll put on my video as soon as the screen is. I stop sharing my screen.
Okay, fair enough. Yeah, go ahead.
So last 1 month or so, there has been renewed concern of a global slowdown. I say renewed because this concern was there even about sometime around middle of 2022 and towards the fag end of 2022 as well. But is this something which is corroborated by data? Well, there's a divergence. There is no black and white answer to this question, whether the global economy is headed towards a hard landing or a soft landing. Now, if you look at the manufacturing data across most economies, what we've done here is picked up the global PMI indices for manufacturing and services. 50 happens to be the threshold for expansion. Anything above that is positive expansion. Anything below that is actually contraction. So if you see how manufacturing has performed, it after struggling for a fair bit of time during 2023, manufacturing actually revived quite a lot in 24. Last two readings have been below 50. So manufacturing is back again in the contraction zone. So there will be divergences at a country level. For example, India will not fit the story. But nevertheless, at a global level, this is what the picture is. So manufacturing has started to face hurdles once again. At the same time, services are doing a pretty decent job. So if you look at where the global PMI services are, they've actually been creating more than 12-month highs. So the concern is not exactly valid when you look at the data in totality. Although if you focus on the manufacturing sector, yes, the concerns have crept in. So there is a renewed concern on the sustainability of global economic demand or global economic growth momentum. At the same time, markets are now focusing on the prospect of hard landing, or so for example, words like recession have now started coming back into the lexicon once again, as you can see it from the Google search trends for the word global recession. It has now started to move up. So that's on the economic data front. Is there any signal that we can derive from some of the asset markets? Well, we decided not to look at equities as such because equities are pretty much in the overvalued territory across the globe. Most of the countries are facing overvalued equity markets. But looking at where commodities are, because commodity cycles and economic cycles are much more better intertwined than any other asset class, because commodity at the end of the day is something which has to be backed by economic activity. Now, we chose the copper gold ratio. This is one of the key metrics or key ratios which have been used in the past to ascertain whether whether the global economy is slowing down, or whether recessionary conditions are building up. Now, here we note that the copper gold ratio is at its lowest point in the post COVID recovery phase. So, which essentially means that, after 21 and 22, the V shaped recovery that we saw in global economic growth is now slackening. And there is a possibility of growth slowing down rather than growth increasing in 24 or in 25 going forward. So, this is what the copper gold price ratio suggests. Now, one may argue that this could also be the current copper gold price ratio be polluted because of extraordinary increase in gold prices, which has nothing to do with recessionary conditions as such, but it has more to do with central banks buying gold. So since central banks are buying gold of late, especially in the last 2 years, it has led to a run up in gold prices, and because gold prices have run up, the copper gold price ratio is coming up. That is a valid argument. So we decided to look at other commodities as well, and commodities according to various end users. So, for example, look at energy, look at industrial metals, look at agriculture commodities. Now, all these commodities are at multi-month lows. Now, this is status as of August. If you look at the high frequency status in September, all these indices would have slipped to further lows. So, for example, energy is at a 6-month low, industrial metals are at nearly about a year low, agriculture commodities are also nearly about a year low, 10 to 11-month low. So, the broader message that commodities are giving is that there is a slowdown concern. It need not be the buildup of a recessionary conditions as of now. Now, from India's perspective, I think the most important commodity is crude oil. And crude oil is currently on an average basis, September month, trading at $74 to a barrel. This is almost a 3-year low. Basically, whatever run up that we saw in the post Russia Ukraine world has now been completely wiped out. And this has happened at a time when OPEC has actually regulated supply. So not only the geopolitical risk premium is there in the system, even the supply has been regulated by OPEC. Despite that, crude oil prices are coming up. So this tells you that definitely there is a slowdown concern which is there on the radar, and to a large part, this slowdown is coming from EM Asia, predominantly China. I would say to some extent also India, because India last year the GDP growth was 8.2. This year, by and large, the consensus expects a nearly about 120 basis points downward, followed by Latin America and US off late. So off late is that it's just been a
I think Vivek's voice is not audible.
Yeah.
He may not be knowing that his voice is not heard. Someone calling.
Venkatesh, can you give me a thumbs up if I'm audible now? Okay, great. Great. So trade has been in a highly uncertain zone in the last 9 years, and of these 9 years, the change in presidency in US coincided with that. So 2016, end of 2016, the world kind of changed with respect to trade protectionism, starting with the US-China trade war, and post 2020, so post COVID, there has been a spurt in trade related protectionism. So whether it is in the name of onshoring, nearshoring, friendshoring, there are various forms of shoring which now the industry is talking about. And at the same time, there is also a genuine need to start diversifying your supply chain, because most of the countries had a terrible experience post COVID in terms of their concentration of supply chain risk with respect to just one or two countries. So there is a genuine need to do that. Also, at the same time, there is a bent or a shift towards protectionism, whether it is in the form of, let's say, on the in the garb of securing domestic manufacturing jobs, or whether it is in the garb of protecting national security. Whatever be the premise, in post-COVID, there has been a phenomenal surge in harmful trade-related interventions by all the countries, most of the countries in the world. And this is sort of an environment is typically not conducive for global trade. You will see a lot of countries on the back foot, especially countries which are much more open in terms of their trade relationship at a global level. Now, not to forget the upcoming US presidential election. It's something which is extremely important for the global economy. And the initial posturing or the initial positioning that we are seeing from a political angle gives one the sense that the trade protectionism in US is probably going to worsen after the 2016 episode. 2016 was the first episode that we saw, and maybe in 2024, the second episode, you'll probably see trade protectionism worsening. If Trump comes back to power, it will be a worse form of trade protectionism. Even if Trump doesn't come to power, even in case, let's say, the Democrats are able to retain their path, even in that case, the protectionism levels are not going to come off. So the world is going to be extremely uncertain as far as trade is concerned. Now, so I highlighted both short-term as well as some medium to long-term concerns as far as the global economy is concerned. In this kind of an environment, how has INR performed? Now, if you see, INR typically does not do well when environment is risky, when environment is not clear, when environment is not uncertain. And we've seen this playing out in case of INR. So INR has been weakening, and FY25 it has just created a new all-time low, almost touching 84 levels. So if the FY25 trend were to persist, then this would be the fourth consecutive year of INR weakness vis-a-vis the dollar. So INR is behaving according to the global premise. However, one thing is very different this time around. The difference is in terms of volatility. So the chart on the right-hand side plots 1 year rolling. These are realized vols in USD INR. And last 2 years, the realized vols in USD INR has dipped precipitously vis-a-vis the long-term trend. And in fact, the current levels of realized vols are the lowest since 2002. So although INR is weakening with respect to the global environment that I just outlined, which is this is how typically INR behaves in such kind of an uncertain environment. But the difference this time around is in terms of volatility. The volatility is extremely, extremely subdued. And what is causing that is, I think, two factors, predominantly from the structural point of view. One is the attractive growth condition, which India seems to enjoy. And so all said and done, so I know I just mentioned that India, along with China, is one of the regions in the EM Asia where growth will decelerate this year around. Despite the deceleration, if you do a simple percentile rank of India's GDP growth vis-a-vis all the other countries in the world. So there are about 170, 180 countries in the world for which IMF publishes GDP growth data on an annual basis. So what we did was calculated a percentile rank on a 5-year moving smoothened basis. And what we see right now is that India is currently at a 96 percentile. So basically what it means is just 4% of the 170, 180 odd countries are currently boasting of higher than India's GDP growth. And in fact, on a trend basis for which the forecast period runs over the next 5 years, the 96 percentile rank, India is 95, 96 percentile rank is something which India is able to secure for the next 5 years. No other major economy in the world is probably able to do this. And this high percentile rank of 95, 96% for India is at its best since the time data is available. So we have about 40, 45 years of data. And in that time span, this is probably the best relative performance. I'm not talking about the absolute performance here. We're talking about the relative. So India relative to rest of the world. This is probably the best time for India in relation to other countries in the world. So that's on the growth side. So growth typically helps because growth determines what kind of foreign investment flows are you in a position to attract. And looking at where things stand today, we have no doubt that India will probably be, funding its current account gap very easily. And in fact, in the process also will be generating balance of payment surplus. So the chart on the right-hand side also kind of corroborates that structural factor where services trade now almost funds nearly about 70 odd percent of the merchandise trade deficit. So that has been a trend improvement barring the COVID spike. So COVID spike that you see is on account of commodity prices uh, uh, falling precipitously, and because of which the merchandise trade did not perform well, and that's the reason why you see that spike. But otherwise, on a trend basis, the services trade surplus or services exports are now increasingly financing a greater part of your merchandise trade deficit. That's a good structural point to look at from a funding angle, because it tells you that the current account deficit gap or the current account gap is not going to be extremely high. In fact, our forecast for FY25 current account gap is at 0.9 percentage points of GDP, just a mild increase from 0.7 percentage points of GDP in FY24. Having said that, it would still continue to remain below the long-term trend of 1.3, 1.4 percentage points of GDP. So our deficit is curtailed. Our growth outlook is extremely promising when you see it from a relative perspective. And all this boils down to saying that in general, your investment flow should be supported, barring geopolitical shocks of extreme nature. So the fundamentals are in INR support, but coming to the topic, the valuations are getting stretched. And the latest data that we have from the RBI, they published the real effective exchange rate data for INR. They take about 40 currency basket and use those 40 currencies to compute the RER index. The latest data is for July. It indicates a little over 9% overvaluation in INR. And this is from the long period average. And what we notice is that INR typically has been an overvalued currency. So if you look at the graph, it has in general it has been overvalued rather than being undervalued. So we've tried to account for that fact that in general INR continues to remain an overvalued currency. But given the fact that it has been in the overvalued territory for quite a longish period of time, the 9.3% overvaluation still looks extreme when you do simple statistical analysis. So it's a one standard deviation move vis-a-vis the mean, and that puts INR current overvaluation at an extremely overvalued territory. So, just on a mechanical interpretation of this would be, let's say, if the question is what value of USD INR would make the RER overvaluation disappear, or there will be no overvalue, or the currency will be at fair value. So a mechanical interpretation implies any level of 91 to 92 on the spot will lead to a complete rupee trading close to its fair value. So basically, the overvaluation will completely disappear, and rupee will be at resulting in correction in the spot rate. And this correction has started. So if you see, July 24 over July. So basically, there was a residual amount of depreciation which did not happen, and that led to an overvaluation in INR. Now, post or since August till now, INR has corrected, but so has other currencies. So while INR has lost ground, there are other currencies also which have lost ground. So we have made some progress with respect to correction or reduction in the overvaluation. But looking at the pace at which it is happening, I think it's a very small move, and probably it's going to take some time before INR gets back, or at least the overvaluation levels become much more acceptable or much more palatable. Now, we had done this exercise earlier where we simulated what kind of impact does an extreme overvaluation, where we define extreme overvaluation as a one standard deviation move above the mean. So what we notice is that whenever such breaches happen, roughly about a 3-quarter lag, you see INR depreciating by 3 percentage points. And again, a mechanical interpretation of this rule would imply INR trading somewhere close to 85, 86 levels in the next 3 to 4 quarters. Does INR overvaluation necessarily imply a depreciation in the spot rate? Well, historically, most of the time, whenever you see INR is extremely overvalued, then it does lead to spot depreciation with a lag of 1 year. So the quadrant on the top right-hand side is the quadrant of RER overvaluation and spot depreciation. So most of the RER overvaluation coincides with spot depreciation in rupee. Now, coming back to what kind of impact to expect and how would policymakers probably react to such a scenario? Well, so in the current situation, if we see most of the currencies are slightly on a firm footing with respect to what's happening globally about Fed's anticipated monetary policy pivot. The market has repriced a lot of rate cuts beginning September. And depending upon whom you ask, the broader consensus is that the minimum 75 basis point of rate cut is going to get delivered in this calendar year, and a maximum of 125 basis point rate cut is possible in this calendar year from the US Federal Reserve. So given this backdrop, the dollar has been somewhat softish, and a lot of currencies have depreciated in the recent months. Now, despite that, INR has been absolutely stable. In fact, we could say that it has actually depreciated marginally in the interim. And RBI's reserve accumulation plays a significant role in this context. So why is there a need to build reserves? First, obviously, the need to build reserve is because you want to correct the extent of overvaluation. The more you prevent appreciation happening when the tide is in favor of appreciation in emerging market currencies, the more your opportunity will be there to curb your RER overvaluation or rupee overvaluation. So if you see what RBI has been doing in the last few years, especially since COVID, is that it has been accumulating a lot of reserves. The reserves are currently at an all-time high, almost touching, I would say, $600 billion. This is in terms of foreign currency assets. We are not including gold, etc. here. So despite reserves touching an all-time high, your import cover is still close to 10 months. So it's not gone to 14 or 15 months of import cover, the highs that we saw in the pre-global financial crisis time. So we're not even considering the COVID spike. So COVID spike was temporary. We are not considering that. But pre-global financial crisis, the number had touched 14, 15 months. And RBI would probably want to be there, maybe not 14, 15, but definitely higher than 10 months of import cover. One, to curb the extent of currency overvaluation, and two, to start getting used to an extremely uncertain global environment. So we talked about how things are completely unpredictable and uncertain on the global side. On top of that, India is also seeing a lot of debt flows with the global bond indices. And with global bond indices, when the flows are coming, it's fine. It's absolutely welcome. But you are also exposing yourself to scrutiny of some of these foreign portfolio investors. And whenever the macro conditions are not good, you will see a lot of pressure from some of these foreign portfolio investors too. So you want to build that reserve for that rainy day. That's something which is absolutely desirable. A secondary point is that the recent reserve accumulation exercise is giving RBI the legroom to pass on a lot of dividend income to the government. So if you see RBI, so the dividend income from the RBI, that the government receives, if you subtract that from the fiscal deficit probably will be about 0.9 percentage point, 90 basis points higher than what the government is budgeting now. So RBI is also contributing to some extent in helping to curb the fiscal deficit pressure. So that also helps you. And there is plenty of room to do that. So if you look at where this current spot is, so this is as of July data, the average value of spot is 83.5, whereas the average price of reserve accumulation is 65.5. So that's the computed average price of reserve accumulation that RBI probably would be having on its book. Essentially, what it means is if RBI is buying dollars, it is buying at 83.5. If it is selling dollars, it is selling at 86. It is selling at 65.5. So there is a clean spread of almost 18 big figures that the RBI is making in this deal. And with this kind of a framework, RBI is in a position to contribute positively towards the government's revenue. So having said that, we believe the two-sided intervention from the RBI will possibly continue. And that has been pretty much the trend in the last 3 to 4 years. However, there will be one important distinction which we believe will probably stay on in the near term, is that we believe the interventions will continue with an eye on allowing INR to underperform whenever there is an EMFX strength tide. So whenever there is a strength in emerging market currencies, you will see INR underperform. When the tide is on the other side, RBI probably would be happy in allowing rupee to follow the broader trend. So what is the outlook? Well, our outlook is actually not changed. We have been pointing this out for quite some time that we are probably one among the few in the market, maybe maybe the minority in the market, who were calling for a rupee depreciation even about 6 months back. As you can see, 6 months back we were at 84.5. For year ending March 25, the market was closer to 82.70, 82.80 levels. So essentially, market was looking at a minor appreciation 6 months back in rupee for the year ahead value. We were constantly at 84.5, and the market in the meantime has moved up from 82.70 to 83.20 or 83.30 levels for March 25. So there has been some adjustment vis-a-vis what market is expecting. We believe there is still scope. The market is still underpricing the depreciation pressure, according to us. Although the depreciation pressure is something which is not going to be immense, it's not going to be significant because of the positives, because of the positive spillovers from certain macros that we talked about earlier. But having said that, that depreciation pressure will probably still be there, and it actually works in favor of the policymakers in India. At the same time, there is a tailwind that one could expect from the US Federal Reserve. The market, as I said, is currently pricing in 75 basis points to 125 basis points of rate cut from the US Federal Reserve, with the first rate cut in September. So these are the dynamics in which we believe INR would probably continue to operate. And the Fed's anticipated monetary policy easing, although there has been a lot of ink which has spilled over this, we believe it's not going to have a secular dollar decline impact. A few reasons why it's unlikely to have a secular dollar decline impact. One is because Fed is a late entrant to this rate easing camp of central bankers. Number two, among all the economies that have probably started easing or are likely to ease within the next 3 months, the US economic outlook is probably the best among the lot. So, if you think about it from that perspective, that central banks have now started to cut rates because inflation has corrected a lot and growth concerns have started coming back on the table, then of these concerns, growth is the least of the worries in case of US compared to the other economies. So while yes, the central bank would still act and probably cut interest rates, but another way to put it would be that US probably is the best among the lot that are probably now easing interest rates are going to interest rates. So from that perspective, also we don't expect a secular decline in dollar in the near to medium term. So our view remains unchanged, 84 half vis-a-vis 83.
Vivek, we lost you again.
So I'm not too sure. I'm saying that brings us to the end of our presentation. Now over to you, Venkatesh.
Yes, Vivek, we lost your last 1 minute. That you said the
Last,
USD range. You said
yeah.
83.52. What is the range you put it up to 31st March or something? You said that we missed it.
So we are giving a point number 84 half for March
Yeah.
25,
Yeah.
and this is about it's higher than where the market expects it to be on a consensus basis. The consensus is at 83.2 levels for March as of now.
Understood. Okay. So can Rao, can we take questions for Vivek now, or I'll request Mr. Yashwant Rao to speak. I think afterwards we'll take Q&A. Rao sir, over to you.
Okay. QuantEco's team, especially Mr. Vivek, has done an insightful research and presented their opinion on dollar rupee based on economic factors. Their comprehensive and thought-provoking presentation provides a solid foundation for discussion on the topic. I was particularly impressed by his arguments about the valuation getting overstretched and about fixing a band for dollar rupee as we move into 2025. It's clear that a lot of effort has gone into this, and this sets the stage for a deeper understanding of the topic. Sometimes it will be uncannily sort of same type of levels we get. It should be known that we don't discuss about the topic. Their research is separate, my research is separate. So sometimes that's what I said. It's amazing that both of them will lead to almost very similar conclusions. I'll just start with a small presentation, about 10-15 minutes only, not more than that. Are you able to see a blank screen, PPT?
Yes, sir.
Vijay?
Yes,
Okay.
yes.
Yes.
Okay. Okay. So, following the extract from a report which we sent on for September, monthly technical analysis report for September. That time, dollar rupee 83.85. So this is the forecast. Monthly chart price action suggests that the dips could be held in this area. I have given a little more leeway on the downside than the upside as compared to this. I will explain that also briefly. And next, I have given what if this happens or what if that happens, like 83.59. It's much lower. That risk is not there as of now. Now, this is the chart. Instead of see, this is the chart which shows that you see there is a green line and a red line here. It is a volatility index. It's not the volatility, standard volatility, which bankers talk about using the close only prices. It is taking into account the range of this is a fortnightly chart. Since I'm preparing a monthly report, I generally do my analysis based on weekly and fortnightly charts so that it can be a bit more accurate. So this is the upper volatility band and this is the lower volatility band. Generally what happens is when the price are moving in an upward trajectory, it will have a tendency to touch the previous month's volatility band, which is at 84.16. I can show you that. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16. 84.16 See, this is the actual chart. You see here, I'm taking that the value appearing on the screen is 84.23. That is the current months. I'm taking the previous months, which is at around 84.16, 84.1675. So upper volatility band for the previous bar 84.16, and this value is 84.23. So 16.23 is the value. On the lower side, I have not taken the red line. I have taken a sensitive moving average. The price is in an upward trajectory. I have taken the sensitive support, which is at 83.25 latest. 83.25 is the level. I'm not getting it now. This anyway. So I have got these two levels for the next month or two for dollar rupee alone, and one second. I'm moving back to the PowerPoint slide. And simultaneously, I see so many other things that are related to dollar rupee. I find the correlation coefficient between this dollar index and the dollar rupee and the gold and the interest rate differentials and such things. See, this is the forecast for dollar index, DXY. Monthly chart, this is a big picture. It is favoring. In my annual report, I have given a detailed wave count, which I continuously follow with almost every chance I am showing that picture. Started gaining strength recently it has started gaining strength. So I have given a bullish view for the coming 2 weeks, 3 weeks like that. It is initial recovery to 102.15, 102.65 like that. Presently it is at 101.60. ECB left the rate unchanged. So it is still on the way. There is no surprise. So it is on the it's on the way a little higher. And unexpected, these are the risks. If it crosses above 103.20, chances for it will go higher, 185. These are the risks. The view is this. This is the view. This is the chart which I told you about. Like, see now I always keep this chart with me. It's a long-term analysis which I have done. So every now and then I delete the old commentary when there is no room in the chart and substitute with the latest commentary. The weekly chart shows this is the resistance level which I have given for the year. It will not cross this, but it will go break this trend lines and all and then go down. If you see, it has entered into a sideways move. It is a consolidation, sideways consolidation generally breaks down into the earlier trend. This is the trend, the downtrend. So the view is it will consolidate around this area and then start going down. That view only I have given in this commentary for dollar index. So dollar index, I have a bearish view in the big picture, but for the moment, it is going to rise higher. So I tend to believe that this will have some effect on dollar rupee also, not directly with a higher correlation and all, maybe inches. If it goes by miles, it will go by 1 paisa, 2 paisa like that. And this is the comparison between this one is dollar index and this one is Chinese yuan. You see, in 2022, it fell sharply. That fall is here, this area. This is 2012. It fell. And afterwards, it fell and fell. Nothing happened. Then it was going in sideways, but this one started going up only. Within this is actually in classical technical analysis, this pattern is known as a rising wedge, or in Elliott analysis, they call a diagonal triangle. It generally climaxes without breaking above this and then collapse below the lower line. That is how if you are trading in a metal or an, energy product, agri product, most of the charts will show a very similar product pattern where diagonal triangle develops within a contracting range and finally breaks and falls below. There are occasions when it goes above the trend line. That will be a blowout, that will be violent. That move will be very sharp. So, if you see my commentary, I have given much lower level and a little higher level also. That is because of this pattern. We are approaching the ending stage of this, maybe this month or the next. It may end here and then it may start moving either higher or lower toward the, at least to the lower end of the triangle. And you see similarly, Chinese also, this is 2022, then it rallied. You see such a lively move. But in dollar rupee, the moves are not as exciting as in other countries. It is totally put in a straight jacket. This is another study. This one is on the left hand side is US 10-year minus India 10-year minus US 10-year. On the right side is India 5-year minus US 5-year. If you see, it is falling, this is rising. Okay, understood. Inverse relationship, inverse correlation. Now, in this, I don't have any MACD moving average, anything, just a line chart. It is a common sense analysis. It has been making a lower low, lower low, lower high, like that. For the first time, it has broken this and started a move higher. That is, it has broken this pattern. The pattern of lower lows and lower highs has been broken for the first time. When this starts rising, same inverse relationship can pull dollar rupee down. But since the guardians are not allowing a deeper fall or a stronger rise, it may at the most come to 83.50 or 83.25, not much. So this is one of the indicators which gives you a hint that the time may be nearer, that it may be going towards the peak, going towards the climactic position of that diagonal triangle. You may get a decline. So this thing is supportive of that. This kind of breaking the pattern is not here yet on 10 years. On 5 years, it is visible. Then lastly, this is the chart of crude oil WTI. I have used WTI because it's a very easily available chart. You see here, this is a monthly chart. It is moving in a triangle. Sometime back, I showed you a triangle. In dollar index, it was going into a triangle. Same thing. This was also moving into a triangle. Then it broke below a sideways triangle, hinting that the move is going to be down. This chart was printed on the 10th September, 2 days ago. It went lower than this also. So this one is putting an end to the uncertainty about the direction. This should help rupee not to weaken. That is, it will lend strength to rupee. So summary is the chart of USD INR studied in isolation. Chart of DXY studied taking guidance from US INR future path. Comparison of USD INR was made with DXY and USD CNH. Comparison was made with the yield differentials of IN US 10 years and 5 years. Crude oil bearish tendency was noticed, which might help keep USD INR down. So if you see all these things, you will get an impression that dollar rupee has a slightly better chance to go down. That is the reason why I have given, go to slide 1. That is the reason why I have given, I told you, I have given a lower, this is the general belief that it is going to 84.15, 16. But I have given this, taking into account the evolving pattern where things indirectly show that dollar rupees, the strong days may be temporary. It may start coming down, maybe in the same upward direction only. Within a strong uptrend, it may come cyclically, it may come and touch the support areas. So I have given this, and these are the support. This is the risk level. Why this kind of wide area is given? You must see my daily commentary or weekly commentary for the real life ranges. This will help our clients. Our clients are mostly importers, exporters. They are generally guided by this. Suppose they have to buy an option or sell an option or whatever, they pick a particular level and they take action. And we may, this was written on the first, by 14th, 15th, it may change also. We may tell them, make some adjustment to this view and present them with a new strategy, and so that their risk management would be much better. With this, I end. Over to Biju.
Sir, for that brilliant as usual technical analysis. And it's really appreciable the factors you are considering to get the correct levels of buying and selling. And as I always say, not only in dollar rupee, even in other currencies, your technical analysis and supports and resistances are helpful for clients to enhance as well as the value as well as risk management. Simple analysis, Vivek's reports and Yashwant Rao's report. I personally kept the invoices, exporters not covered, and it is giving me 50 to 60 paisa advantage per dollar. In a market where most of us say that nothing happens in dollar rupee, if you add 50 to 60 paisa per dollar on say $10 million, it's a good value addition, which is a very good value addition. In case of euro dollar and other things, there is market was volatile and there is see what I am trying to tell Rao sir and Mr. Vivek that even in a market like this, if the rupee is managed prudently with a good fundamental and technical views, there is value addition possible. There is risk management possible. See, you are right, Vivek. You are consistently saying that rupee depreciation, maybe last 6 to 9 months against market expectations, and some of us always believe that the growth is good. Growth is good. Dollar index is not doing well, and why Reserve Bank has to buy and protect the dollar? You have given a reason for that. There is a need to buy on good times so that when the market attacks, there will be smoothened volatility. And of late, it is central bank strength to keep the currency stable. Even Japan proved that they can keep the currency bit stable. That is all central banks makes an attempt, and our central bank is successful in it. Nothing wrong in it. It is always stability of currency is a very critical uh, point for the economy. Any questions to Vivek or Rao? I will take 2, 3 questions because we are already delayed. 3 questions. We are happy, Vivek. There are still 35 participants are there. Yeah. Any questions specifically on whatever Vivek spoke or Rao sir spoke? Anything, Vivek, you would like to add?
Yeah, Prajot here from Raj.
Yeah, yeah, Prajot, go ahead.
Yeah, so my question is to Mr. Vivek regarding the overvaluation stretched and all that. As you rightly also stated that in month of August, we have the means rupee, all other currency have actually appreciated against the dollar, and there is some correction in that overvaluation of the rupee. So to what extent we can expect that the RER number to change in the month of August? Means of course, a lot of inflation data are not still out, but considering the trend, what the US has already shown from 2.9 to 2.5% CPI inflation, and considering other current countries also some sort of correction, means reduction in the inflation. So that 7 or 6%, whatever the overvaluation must have corrected to some extent. So just something on if you able to put some light on that.
Thanks, Prabjot, for asking that. Now, it's somewhat difficult to ascertain what exactly will be the impact because when RBI publishes that data, it does not have inflation data for all the 40 currencies for which it compiles the RER index. So what they do is, so August data will be published in the middle of September. And at that point in time, maybe half of your basket will not be even having that CPI number with yourself. So what they do is they typically just extrapolate. So it's an assumption that they make. So August data is bound to get revised. So any month's data is bound to get revised when they have CPI inflation numbers available for all the countries. That's true. That has been the trend. Now, does that make a difference? So our observation is that in terms of RER, almost nearly 75-80% of the changes in RER is accounted for by relative spot movement. The remaining 25 to 30% is accounted for by inflation differential. So the spot movement on a relative basis has more than times impact on the RER than the inflation differentials. This is the historical trend that we have observed in RER changes on a month-to-month basis. Now, what has happened in August? Yes, a lot of currencies did strengthen. RBI did not participate in that rally, and for that, to that extent, we were an underperformer. And that's probably also something which we highlighted in our presentation, that when the tide is in favor of emerging market currencies, RBI will be very happy to let rupee be an underperformer. And this will be a trend that will possibly continue. Now, how much of that underperformance will correct the RER? Well, my sense is that it won't affect much. Maybe a percentage point it can be lower. So 9.5 could possibly become 8.5, because while some currencies did appreciate and our INR did not, INR actually went the other way. At the same time, there were a lot of emerging market Latin American countries which actually depreciated much more than RBI, much more than INR did in the month of August. So, if you remember that chart that I had, almost half of the currencies appreciated, half of the currencies depreciated in the month of August, vis-a-vis since July end. So, not maybe more than 1 percentage point impact can be expected in August data. It would be my guess.
Okay, thank you very much. Just extending one point means going to back to very basic with respect to RER overvaluation. With RER, we are looking for tradable sector and especially on the goods side only, because I think the weightage is given only on the goods exports. So first of all, should we see the export RER or a trade weighted RER? One. Second, the impact, because India became our services, especially in the last 4-5 years, which you also pointed out in your presentation, has grown sharply. So in that scenario, is RER in a way a very good indicator, or should that the basket should also add from goods to services also in that calculation?
Well, so we make a lot of approximations here, Prajot. So what we do is, so when we look at the RER index, yes, agreed, it has weights which are more in sync with your merchandise activity rather than the services activity. And these weights were decided in, I think, 2015, if I'm not mistaken. That was
Yeah,
the
but I
last
think that gets changed every 3 year rolling basis. Every year rolling basis is there.
Well, there are various metrics. The one that we typically look at has a change in, I think, almost every 5 years or so. So there is also a rolling index which RBI publishes, but for the purpose of illustration in the presentation, we have used the one which has a fixed weight, which gets updated every 5 years or so. So agreed, it is biased towards the manufacturing sector because it has merchandise exports, not exports, merchandise trade as a trade share, and that too in 2015. So if you have to compute them today, those trade shares will also see some amount of change. That's one. The second aspect is that there's no representation of services, which is true. Now, what will happen if, let's say, we were to make some adjustments and try for services also to be a part of the RER, or at least services related trade also to kind of reflect in RER weight. So we make few assumptions when I said we deduce the extent of overvaluation in INR and try and project that overvaluation on spot dollar rupee, which is actually not correct, because when you are looking at an RER index, you're looking at a 40 currency basket, INR against those 40 currency. The interpretation which market draws is channelized towards USD INR spot, which is not correct technically. But since that's the easiest thing to do, that is what the market participants do, and that is what we also did in our presentation. So the inference that we drew from INR overvaluation, all those analysis was geared towards what is going to happen to USD INR rather than what is going to happen to the NER. Ideally, the RER correction should start getting reflected in your NER, which is your nominal effective exchange rate basket. But we say that this is how it should get reflected. Well, a few reasons. One, because it is convenient. Two, trying to do that same analysis on a 40 currency basket, the interpretation would be extremely difficult. And that is why that is where the convenience part comes, because USD INR is something which is much more relatable than a 40 currency basket. So if I have to tell you INR will depreciate by 2 percentage points on a 40 currency basket, you will not know what to make of that particular statement. Whereas if I say that INR will depreciate by 2% against dollar, it's very easy to interpret and relate to what I just said. Now, if let's say we have services as a representation also in the INR, in the RER basket, then for regions like US will see a surge in their weight in RER, because a large part of our services is geared or goes to US. So predominantly, I think so. Services basket is not as bifurcated or not as well diversified as the merchandise basket is. So probably services, the top 5 countries that would be there, maybe US, Europe, and the GCC. Again, GCC, if you include from a currency perspective, a lot of GCC will actually help in boosting dollar's weight because it is nothing but a dollar-pegged currency. So in a nutshell, if I have to include services, the weight of dollar will probably increase much more. And when we make those approximations and say that this is what should happen to dollar rupee, it will become even more concrete when you make that assertion. Basis of services also getting included in the RER basket. So the approximations that we are making right now will only get better if you include services. Is what my assertion is.
Thank you.
Okay. Thank you all. Thank you, Vivek. Thank you, Yashwant Rao, sir, and all the participants for joining us. And we would request that we'll send an individual mail for all of you as a complimentary copy of Periscope. And we would like uh, you all to subscribe. The subscription amount will be specified in your mail. Thank you once again to all.
Thank you so much.